Let's begin by understanding the different uses of financial statements. Financial statements help investors in knowing the financial health of the business. It helps us in making wise investment decisions. Secondly, for internal managers, financial statements help them in integrating the performance of the business and also understand areas where they can improve on. Thirdly, the financial statements also help the creditors and banks who give out loans to the company. Financial statements help them in understanding whether the company will be able to repay the debt and also the periodic interest payments. Let's move on to some more uses of financial statements. The government is also a user of financial scorecards of companies. These financial statements help the government in understanding the profit of the company and thus collecting appropriate taxes. Financial statements help employees in understanding how well the business is performing and thus helps them in gauging their performance and also their incomes from the company. Audited financial statements is the report which gives an independent opinion on the position of the company. Before we dive into the types of financial statements, it is important for us to understand the difference between cash and accrual accounting. The difference lies in the timing of when sales and purchases are recorded in your accounts. The cash basis of accounting recognizes revenues when cash is received and expenses when they are paid. This method does not recognize accounts receivable or accounts payable. Many small businesses opt to use the cash basis of accounting because it is simple to maintain. It's easy to determine when a transaction has occurred and there is no need to track receivables or payables. The cash method is also beneficial in terms of tracking how much cash the business actually has at any given point of time. You can look at your bank balance and understand the exact resources at your disposal. Under the accrual basis, revenues and expenses are recorded as and when they are earned, regardless of when the money is actually received or paid. This method is more commonly used than the cash method. The upside is that the accrual basis gives a more realistic idea of income and expenses during a period of time, therefore providing a long-term picture of the business that cash accounting can't provide. The downside is that accrual accounting doesn't provide any awareness of cash flow. A business can appear to be very profitable while in reality it has empty bank accounts. As we know by now, business transactions are identified, recorded, and then summarized in a presentable format. The summarized data is presented in 4 financial statements that shows different aspects of the business. They are the income statement, the balance sheet, the cash flow statement, and the statement of changes in owner's equity. The first is the income statement. The income statement is a corporate scorecard which shows the total revenue generated by a company in a particular period, the total expenses incurred, and eventually the profit earned. In a very simple way, the income statement gives you the following equation: revenue minus expenses is equal to profit. Remember, the income statement is prepared in an accrual way. That is, they don't follow a cash system. The company will book revenue if the service has been rendered, even if the cash hasn't been received. So we need a corporate scorecard which shows the flow of cash in a particular period. In a simple way, the cash flow statement gives you the relationship between the beginning cash balance and the closing cash balance. It summarizes information concerning the cash inflows, that is receipts, and the cash outflows, that is payments for a specific period of time. Lastly, the statement of changes in owner's equity. This financial statement shows us how the company's owner's equity has changed from the last year. Here you can see that the balance on 1st of January was 51 million, which has increased to 66.5 million on December 31st. A statement of changes in owner's equity shows the changes in the capital account due to contributions, withdrawals, and net income or net losses. Capital is increased by owner's contribution and income, and it is decreased by withdrawals and expenses. Next, the balance sheet. The balance sheet is the corporate scorecard which shows the assets owned by the company and the claimants on those assets, which is the liability and owner's equity. In a very simple way, the balance sheet gives you the following equation. Company's assets is equal to liabilities plus owner's equity. This is an example of a balance sheet. The balance sheet shows the position of a business as of a particular date. On the left side of this balance sheet, you see the assets of the company. And on the right side, you have the liabilities and shareholders equity. Let's understand what we see in the balance sheet. Assets are everything that the company owns, while liabilities is everything that the company owes. Owner's equity is also treated as a liability from the company's perspective. Note that the assets and the liabilities should always be the same. They should balance. And yes, that is the reason why you call this scorecard as a balance sheet. Assets are resources owned by a business which help in generating economic benefits for the firm, or which can be converted into cash in short term. The diagram on the screen shows the basic balance sheet equation. As you can see from the diagram, assets equals owner's equity and liabilities of a company. Here's a question for you. Which of the following is an asset? A bank overdraft, a receivables, or sales? Bank overdraft, if you see, is something that the company owes to the bank, which means this is definitely not an asset. It is a liability actually. Sales is actually not even a balance sheet item. It is not something that you own. Sales is an income statement item which tells about the amount of revenue generated in a particular period by the company. Now if you think about receivables, receivables are sales which the company hasn't collected the money. Getting it? Which means receivables is an asset. It is going to give company a future benefit. It is an asset which is going to be converted into cash. Getting it? So receivables is a current asset which will be converted into cash within a year. Now let's understand a few other balance sheet items. Fixed assets. Fixed assets are long-term assets. These are assets owned by the company which won't be converted into cash anytime soon. Fixed assets are used by the business for generating sales. Some examples of fixed assets are land, buildings, machines, plant and equipment, furnitures and fixtures, etc. Current assets or floating assets are assets which are more short term in nature. That is, these assets may be converted into cash in less than a year. Some examples of current assets are receivables, inventory, etc. Next, liquid assets. Liquid assets are assets which are already in the form of cash or which can be easily converted into cash. For some examples of liquid assets are cash, treasury bills, money market instruments, or any money market investments, bank balances. Now, current assets and liquid assets together, you can call it as your total current assets. Continuing on, let's talk about wasting assets. Now, wasting assets are those fixed assets which have a fixed content like coal in a coal mine. The value goes down as the contents are taken out. When the minerals have been taken out, the coal mine becomes useless. Then there are intangible assets. What are intangible assets? Intangible assets are those assets which cannot be seen or touched or felt. Goodwill is an example of an intangible asset because there is no physical form to show. Intangible assets are not necessarily useless, they have value. Software is an example of an intangible asset. Patents is an example of an intangible asset. Next, finally, let's talk about fictitious assets. Are valueless assets but shown as assets in the financial statements, such as trademarks or expenses treated as assets, such as in prepaid expenses. The flip side of assets is liabilities. Liabilities are claim against the assets. Liabilities mean anything that the company owes. Liabilities are again of two types, current and non-current. Current liabilities are liabilities that has to be paid in less than a year. Non-current liabilities are liabilities that has to be paid after a year. Let's talk about difference between assets and liabilities. Firstly, the general meaning. An asset is something which an individual or a company owns, whereas liability is something which an individual or company owes. Next, let us understand from the business meaning perspective. Assets are those objects which are owned by the company having monetary value, immaterial or tangible or intangible. Liabilities, on the other hand, are the debt or the responsibility or an obligation owed by the company having monetary value. Types of assets are current assets and non-current assets. Types of current liabilities are current and non-current liabilities. From a calculation perspective, assets is the liabilities plus the owner's equity. Liabilities is assets minus any residual owner's equity. And examples are, for example, for assets are buildings, cash, goodwill, account receivables, investments, etc. On the other hand, liabilities are long-term borrowings, bank overdraft, account payables, debt, etc. You must have heard this word net worth or shareholders equity. Shareholders have a residual claim in the business. Shareholders equity is the total assets minus all the fixed liabilities. What do you mean by this? It means that shareholders have a residual claim on the assets of the company. Once all liabilities have been paid off, the entire assets of the company is owned by the shareholders. Let's look at an example. Here, the total assets of the company is 60,000, which includes cash, property and machines. Let's say the company took a debt of 20,000 to purchase these assets, which means that liabilities of the company is 20,000. So assets of the company, that is cash, property and machines together, is 60,000. However, there is some liabilities attached to this assets which is 20,000, which means the owner's equity is 40,000. Thus, owner's equity is total assets minus total liability. It represents the ownership claim on the total assets. Next, let's understand the subdivision of owner's equity, which will help us better understand the statement of changes in owner's equity. Owner's equity consists of the capital put in by the shareholders, any drawings by the shareholders in the form of dividends or in the form of buyback of shares, and then the revenue less expenses. That's it for the session. Goodbye.